as we start wrapping things up, what are a couple more things that you may want to just share with us, again, about the Beacon story? I'm just trying to think as well. We've talked about what really started the Beacon concept and the issues and the concerns, the worries of investors. We've talked about the stop loss feature, which is so clever, but is also the mechanism and the math behind when to go back into the markets. We've talked about the advantage the Beacon has of being able to invest across the entire marketplace using the 11 sector funds, very low cost with Vanguard. We also have access to dimensional funds, DFA, and also some select American funds in the portfolio. One of the things, maybe if you could address the thing that I'm finding, is that there's a saying that nobody's deader than last year's hero. No one's deader than last year's hero. In 2020 and 2021, Beacon looked unstoppable. And then 2022, the S&P index was off by over 18%. Beacon went down, but not nearly as much, but it still went down. And I found then going in explaining that year as well as 2023, that some people tend to be very short-sighted and they forget about the enormous run-up they got in for a couple of good years and the math behind the Beacon approach. And they're chasing the highest and the best returns of the moment. Can you just speak to that a little bit in terms of folks that are chasing returns? And what's that do? At the end of the day, does that really work?
Isn't that the story of 95% of all investors in the world over the last 100 years or so? Clients are always doing the wrong things at the wrong time. I mean, you can go to your club and someone will talk about the incredible call they made on a particular stock, but very rarely do they walk into the establishment and say, hey, these were all my losers, right? So folks that are trying to time the market, I mean, even if you use fundamental analysis or technical analysis, those are guides. But in the short term, no one really knows where these markets are going. If we did, we all could have just got out of the market in 2000, got back in 2002. We all could have got out of the market January of 2020 and then got back in on April 1st. But none of us have that foresight. No matter what graphs you have or what tools you have, when the people vote and they start buying and selling stocks, they can move rapidly in a direction. That's why everything we do is based on math and history at Beacon Capital, not guts and guesses. Even tools that rotate from one investment to another, maybe they take a 20% hit on an investment, move it to another stock, and then that goes down 20%. That's almost the definition of catastrophic loss, right? Losing 2 times in a row on 2 different investments. That's why we chose to do the risk on, risk off. When we're risk on, it's based on math and history. But when we're risk off, we're staying in some sort of an investment vehicle that'll pay us yield to park and just step outside. Looking at 2 different investments that have the same exact rate of return over 30 years. In this case, it's 8.05%. One of these investments is much more volatile than the other. It has over a 14% standard deviation, and the other portfolio has a just under 10% standard deviation. That means how high can it go? How low can it go? And what is the difference between the two? What we find is a lower standard deviation portfolio allows us to take a much larger safe withdrawal rate. So notice this, 3.9% versus a 2.5% safe withdrawal rate of the portfolio that had the higher standard deviation. Is that important? Well, it might not seem like much, 2.5% versus 3.9%, but that's 56% more retirement income for an investor by avoiding catastrophic loss and having a tighter standard deviation or a tighter range of returns.
Well, Lou, it's been so great having you with us. And I'm just so pleased, so very grateful to my friend Lou Tranquilli back on back in the New Jersey shorelines, who introduced me to Beacon. And so thankful and appreciative that he suggested that I understand the math and science that's behind Beacon and the algorithms. And it's very emotionless type of investing. And unfortunately, so often investors I found they fall in love with their portfolio. And so they ignore the warning signs. They don't have the downside protection that Beacon builds in automatically. And so if you're listening to this and you're concerned at all, worried at all about how can you grow your portfolios at an optimal rate, but at the same time have downside protection, so you're not worried about having your portfolio drop by 15 or 20 or 25 or 35%, then let's have a conversation. So again, we invite you to just give us a call, arrange for a complimentary conversation, no cost, just simply to talk about, we can certainly address the investment issues, but we can talk about so much more than that. We can address some of the issues that we find with their estate planning, with their insurance, with their tax mitigation, number of other areas as well. So give us a call on the number you've seen on the screen, and we'll be happy to have that 20-minute conversation to just help be a resource for you. Again, much thanks to Lou Bojorquez. It took me a couple of days to figure out how to spell that, but I can tell you that as you've seen and listened, Lou is an incredibly bright fellow. Got to tell you also, he's an amazing husband and father from all reports. And he's also truly been a lovely friend for us. So Lou, thank you so much for being with us today. And again, this is RJ Kelly with Wealth Legacy Group. God bless. Hope you do extremely well in what your day is, but more importantly, that you're also impacting the world in some sort of lasting, positive way. Bye for now.